Welcome back. So now we're going to talk about what is entrepreneurial finance. We got a lot of moving pieces here. So first of all, let's talk about what is entrepreneurship. Now those of you that have been following my channel or have taken my classes previously probably have a pretty good idea of this answer already, right? There's no universally agreed upon definition of entrepreneurship, but we normally say that there is some sort of a relationship between entrepreneurship and opportunity. It could be that entrepreneurship is the process of discovering opportunities. Entrepreneurship is the process of creating opportunities, so that objective versus subjective debate. Entrepreneurship is the pursuit of opportunity, the exploitation of opportunity. It goes on and on. There's no universally agreed upon definition of entrepreneurship. And in fact, if you hear someone who says, I've got the right definition, you've got the wrong one, run from that person. That person has no idea what they're talking about. Stay away from that person. Okay? There's no universally agreed upon definition. But again, there's some sort of relationship. We normally think of, especially with this discussion of entrepreneurial finance, it would probably have something to do with the creation of a new organization of some kind that might make money. But again, that's not a universal definition. I'm just trying to guide you through some of the things that we'll be talking about in this particular course. Then we look at what is finance. Again, that's another big term. And it usually has something to do with managing money, okay, broadly speaking. Now that can mean personal finance, like how do you balance your checkbook? How much money do you spend on groceries versus how much goes into your retirement, right? That's one form of finance. Now the one that you've probably been taking if you're a business major is corporate finance. And that looks at two distinct facets. One is how does a firm or a company invest its assets, right? It's got some money. Does it buy a factory? Does it pay people? Does it buy bonds? What is that company doing with the money that it has? Okay. And how does it acquire additional funds? So is the corporation selling equity, i.e. selling shares in the stock market? Is it getting loans? And how do you manage the try to get those assets versus liabilities to kind of equal out, okay? And this story of pursuit of acquiring money. So entrepreneurial finance kind of blends these two concepts, and there is a particular emphasis on getting public funding versus private funding. So public funding means that an entrepreneurial venture is trading stocks, usually on a stock exchange. And then private funding, which will consist of the majority of this course, is how do you raise money from, for example, venture capitalists, angel investors, friends, family, and fools, etc., etc. Okay, that's the majority of this course is on the private funding piece. Now, that's really, really vague, and I bet you some of you are confused, right? Well, what does that even mean? Okay. So I refer to Saras Sarasvathy's 4 questions that she gives in her causation versus effectuation article. And again, you can find that on AOM. It's in the Academy Management Journal. Or is it Academy Management Review 2001? However, I have a video and a playlist on this channel devoted exclusively to Saras Sarasvathy's article if you'd like to know more. But if you're thinking, hey, is entrepreneurial finance versus corporate finance for me, right? Then look at Saras Sarasvathy's 4 questions. And if any of these questions kind of sort of relate to what you're trying to do, chances are entrepreneurial finance is it. So how do we make pricing choices for firms and industries that do not exist, right? They talk about next-gen wireless technologies. Well, how much... Looks like my camera's a little crooked there. I'm sure that's driving some of you nuts that are watching this, so I'll just fix that. So, how much would something like for the next gen, they have the 4G, the 5G, now they're doing the next generation cellular networks, how much would the products in the next gen industry cost? Who knows, right? Corporate finance couldn't answer that, so that might be an entrepreneurial finance question. How do you hire individuals for a non-existent or contingent organization? In other words, your company doesn't exist yet. How do you hire people for that? And how do you figure out how much to pay them? Or what we call a contingent organization. So let's say you're looking at being a software development company and you need at least 20 employees to get off the ground. If you have 19 employees, you don't get off the ground, the firm fails. You need that minimum of 20. And so that's what we call it a contingent organization. You don't even get started unless you have a certain number of resources, manpower, etc. Okay? It could also mean that you need to raise a certain amount of money before you even get started. How do you value firms in a new or non-existent industry? So let's think about something that doesn't exist right now, although those of you who are watching this video 10 years later may laugh because it'll exist. But let's think about like holograms and real virtual reality, not like the weird stuff that's really not working right now. But you know, like holograms. Well, how do you value a company that's going to make holograms when the industry of holograms doesn't even exist yet? And here's my favorite one. How do we create a capitalist economy in a formerly communist one, or what does a post-capitalist economy look like? Okay. So a communist economy, so for example, I don't think anybody could ever really predict what Russia was going to look like in the 1990s, or let's say, you know, with Cuba opening up, or China opening up, or Vietnam, which is continuing to open up. You know, what would a capitalist economy look like in one of these former communist states? Or North Korea, what if they become capitalist all of a sudden? What's that going to look like? How do you value the firms in that kind of an economy? And a post-capitalist economy. What's post-capitalist economy? Well, those of you who have read Schumpeter, he always says, like, there's going to be a day when people are not, like, you know, greedily pursuing wealth, and people will engage in other kinds of pursuits or endeavors and activities, and it won't be all about money, money, money. I've always thought that a lot of European countries are almost like post-capitalist because they're very socialist. They have a different set of values. It seems to be more about living life than it is just kind of that pursuit of money. That might be a good example of a post-capitalist economy. So, another way to help differentiate, and I've got another video which we're going to talk all about entrepreneurial finance versus corporate finance, but another way to help you differentiate the two, corporate finance and entrepreneurial finance, is looking at the concepts of risk versus uncertainty. Okay? So when you're looking at corporate finance, chances are you've got a large data sheet behind you that's going to help you make an informed decision. So you can say, all right, let's say you're even a beginning entrepreneur, like a really small-time prosaic entrepreneur, and you say, you know what, I have two choices. I want to be an Uber driver in my spare time. I have two choices. I can buy like a Prius, right, for my Uber stuff, and a Prius is good because, you know, I can charge the Uber X, and, you know, the Prius has good gas mileage, and, you know, I can do some calculations based on, you know, similar vehicles in my area, what they're doing, and so maybe that's one choice, right? I could buy a used car, like a used Hyundai Sonata, right? And, you know, I'd calculate the fuel costs a little bit differently, and this might be my profit rate. Or I could buy like a really fancy Mercedes, and I could get like the Uber luxury service, right? And maybe I can make this amount of money because I've got this data. Or I even buy like a Tesla. Like I really spend a lot of money. I buy the Tesla, and that's going to be a vehicle that's, you know, going to have no fuel charges because I'm using the electric, and I can get the luxury service again for Uber, and blah 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 blah. So I can make those decisions. That's risk. Okay. Alternatively, for those of you that remember like your probability classes in like pre-algebra or algebra, you think about the marble game. You got red marbles and blue marbles in a jar, and you got to stick your hand in there, and, you know, maybe there's 10 blue marbles and 10 red marbles, so, you know, the chance of getting a red marble versus a blue marble is a 50-50 chance. And so if you get paid every time you take out a blue marble, or penalized every time you take a red marble, you know, you can evaluate risk, right? Especially if you know, like, the three people in front of you, they've been drawing red marbles, and maybe you know that the chance is going to be a little bit higher that you're getting a blue marble, for example. So this is corporate this is a corporate finance problem. By the same token, an established firm, an established corporation can say, look, we've got all this data. If we take our money and we invest in a brand new factory, a brand new location, a brand new piece of equipment, a brand new employee, we can probably get a decent idea of what the return will be. Now, previous performance is not always an indicator of future performance, but at least it gives you some sort of a gauge. And therefore, with enough research, you can calculate your risk somewhat effectively. Uncertainty is quite different. Okay? Uncertainty is not like risk. Uncertainty means you don't even know what the rules of the game will be, right? So, all right, I have got this brand new idea for a company, and it might make $1 million a day, or you might lose $1 million going into that industry. And I don't have any real way of telling you because there is no previous history of this firm. I have no idea how the customers are going to interact with it. I don't know anything. No clue. And these 4 questions are good examples of questions embracing uncertainty. Okay? If you're dealing with uncertainty, probably entrepreneurial finance is going to be right for you. Okay? If you want to use the probability game from, algebra, pre-algebra, whatever, you got a bunch of marbles in a jar. You don't know how many marbles are in the jar. So every time you draw, it could be 10 red marbles, 50 blue marbles, vice versa. You don't have any idea, right? So when you're dealing with uncertainty, right, instead of trying to calculate risk, you try to control the future. So maybe you start stacking your own marbles in the jar, right, to get the odds, okay? I always laugh at one example of, the marble stacking thing when I was in 3rd grade, I think. And, I guess maybe because I'm a scholar of entrepreneurship, I have kind of a little bit of a trollish personality, a facet of my personality, I guess you could say. And I was always bad. Maybe I still am, but that's not the point. I had my 3rd grade teacher, and she gave these little things, she called them gotcha cards. When you got caught being good, she gave you a thing for, being good. And you'd write your name on the back, and then what you'd do is you'd put them in this jar, and every Friday she'd mix up the jar, and then she'd pull it out, and if your name was on it, you got a piece of candy or a toy or something of this nature, right? Well, there were other kids that were like goody two-shoes, and they always got like lots of gotcha cards, and I never got any. I mean, I got a few, but they might get 15, 20, or 30 in a week, right? I might get 5 or 6. And so I never had any chance of winning, right? Well, I didn't really know how many they were going to get, but I knew they got way more than I did. So this is uncertainty in action, right? So I knew I was never going to win, right? And I didn't exactly know what I needed to do or how many cards I needed, or gotcha cards I needed to actually win the game. So kind of like in an entrepreneurial finance perspective, what I did is instead of turning in the gotcha cards every week like I was supposed to, I started hiding them in my desk, and I saved up like 40 or 50 one week. And it was like way more than all the other kids, I was certain. So I started dropping them all in. And the teacher kind of saw, because she knew I was never good, so she didn't know why, I got all these gotcha cards. And then there was another little boy in my class too. I had gotten some highlighters somehow or another, and I sold some of the highlighters to him for some of his gotcha cards. Completely not what the gotcha card game was meant for, right? So I started, I bought some of his gotcha cards, so I got like another 25 from selling highlighters and stuff to him too, because he was a good student and I wasn't. And so I had so many gotcha cards, and I remember the teacher was so mad. So every time she'd put her hand in, and she'd go, "Oh, there's Duncan. You've already got your toy," because you can only get one toy per week, or whatever it was, toy or piece of candy per week. And then she'd just keep drawing my name over and over and over, and this was uncertainty, right? I didn't. The most efficient way to have done it was if I knew risk, I knew exactly how many, other gotcha cards were in there. I would have put exactly the right number so that I felt comfortable that I would win at least once. But see, I didn't have a clue. So I stuffed in as many of these gotcha cards, as I possibly could, so that I knew that I would at least win once. Now, I actually wound up winning because she used to do, I think she would give out 5 or 10 prizes a week. And she drew my name, and I think by the 20th time, she got really mad because she just kept drawing him. And so this was uncertainty in action. I didn't know, so I stacked the deck in my favor. Okay, uncertainty in action. And so if you're an uncertainty kind of person, then again, you're probably looking at entrepreneurial finance. You're probably an entrepreneur too, right? You want to stack the deck in your favor, just like I did with my little gotcha card scheme. I hope that example helps. My teacher, Ms. Jenkins, if you're out there, I still remember. And by the way, those of you that are wondering what happened, she made a rule that you couldn't do that anymore. But guess what? Because in typical effectuation fashion, I kind of learned, okay, maybe stacking in 75 to 50 to 75 gotcha cards in a week was too much, but I could still kind of save them, and so every 3rd week I'd put them in. And she was suspicious, but she couldn't exactly prove it, right? It wasn't so blatant. I might win 2 or 3 times when she knew she wasn't giving out cards, but she wasn't quite sure enough. It could have been random chance because she was also abiding by the uncertainty principle. I hope that example helps. As always, give me a like, a thumbs up. make sure you hit that subscribe button. And here's a question for you all. Can you all give me some examples of risk versus uncertainty in your own lives? Be curious to hear your feedback. I'll see you in the next video.